Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Wednesday, November 16th, and then see how things look for Thursday, November 17th. And it was a pretty sleepy day. We opened and just kind of went sideways most of the day, had more of a negative flair to it, especially at the end, but we were pretty much negative for the session. And that helped a little bit because our other indicators, especially in the short term, are suggesting that we still have overdone it. And this is kind of the exhaustion that we're seeing right now. Unfortunately, a lot of that short-term overbought condition has not been worked off. So we need more days like what happened on Wednesday, or we need just something more of a pullback just to work off that overbought condition. Now, at the same time, as I constantly say, just because we're overbought doesn't mean that we have to stop going up. We can become overbought, and as we've seen, especially a lot in 2022, our indicators can remain extreme positive or extreme negative for extended periods of time. But it's just something to be aware of. And it's something that I use very heavily to determine more of the timing of everything. All right, let's go back and talk about what happened. Right at the open, it was a lower open, and we opened right at and stayed pretty much on yesterday's daily pivot, which if you notice some of the charts that I use, it keeps little dotted lines where previous pivot points were at, but these can often be influential, but just to open at the previous day's pivot and kind of stay there is a little peculiar, just kind of strange. Not really reading anything into it. It's just kind of strange to see that. But the daily pivot yesterday was at 39.74, and we kind of trailed a little bit above and then ended up going below that as the day went on. Prices ended up just staying there for much of the session and then trailed lower going into the close. We were down 0.83% on below average volume. That could be seen as somewhat encouraging. A down day, a slow day on below average volume. People aren't panic selling. There's not a real force, at least yet, with prices going down. Now, that could always change, but that's why we take this on a day-by-day basis. But at least in Wednesday's session, it was more constructive. And the technicals, they're still positive overall. We're hanging in there with our short-term and even slightly intermediate-term overbought condition. Interest rates are the real focus, and that continues to be the fixation. Although we have all these other geopolitical things going on, it's inflation and interest rates that really have the market right now. The situation in Russia, my understanding is that the bomb or the missile that dropped in Poland may have been sent or was sent by Ukraine. They just kind of sent it in the wrong direction, which is not a very good thing to do. So that hopefully will keep things a little bit more under control in that situation. And then we did have some Fed speak on Wednesday that I'll go through. And I've changed the color of the midterm election just because it looks like it's a little more settled now, where the Republicans will be the majority in the House, and you have the Democrats being the majority in the Senate. The market likes that. It's more gridlock. It's going to be hard to get some things done, although we have seen this real wave over the last few decades of using more and more executive orders to do things, and big things, not just little things. And that's kind of concerning to the markets as well, because we don't really know what's going to happen with all of that. But at least there's a mixed picture in the political scenario right now, and the market likes that. And I really haven't heard any much new or anything new when it comes to the Iran-Saudi situation. Here's the daily chart showing how we had the lower open. There was a little bit of a gap, but not much. But this solid blue line here, that was yesterday's pivot. And we went down that, we went a little bit above it, then down below it. Then we were right on it for a while, went a little bit above it. And then near the end of the day, we went down below it and pretty much stayed down below that level. So compared to some of the other wild days that we've seen, this was pretty calm. What are some comments? The San Francisco Fed President Daly, I think that's how you say that, Daly, who is or will be a voter in 2024, said that the idea of the Fed pausing its rate hikes is not even on the table for discussion right now, and that she thinks that the terminal rate will end up being at about 5%, that's a reasonable level. So that the markets didn't like that one. Then you had Fed Governor Waller, who's a current voter, said that he's more comfortable with stepping down to a 50 basis point hike at the December meeting, following the weaker economic data that we've seen recently. The market did like that. So you kind of had this something that was not really liked, but from a non-voter, to something that was liked from a current voter on the committee. But again, it's Chairperson Powell that's the most important one to pay attention to. One thing that was really interesting in Wednesday's session, and I have a chart to show you this, the daily equity put call ratio, it really spiked up. It hasn't really bled over into our 5-period equity put call chart, but it really went up and went really a lot higher than when it spiked just last week. The dollar was weaker and interest rates fell. That has been giving some support to stocks, but it didn't do that on Wednesday. And here's our short-term indicators. The rate of change going back 5 periods, 10 periods, those are extreme positive. The Stochc RSI, although it's coming down a bit, as well as the stochastics and the Williams percent R, all of those are coming down, but they're still in extreme positive territory. And intermediate term, we still have the BPI, the bullish percent index, as well as some of the PMO studies. They're looking a little better. They are showing less of an extreme positive reading, but they're still in that range. Those continue to be extreme positive. And then I've taken the 30 to the 5-year off. I think I did that in yesterday's video, but we still have a number of our yield curves that are inverted. Sentiment still remains positive. Even with the down day, it's still in that positive area. And we had a whole slew of different economic reports, and there's a whole list that I'll go through here, but it was retail sales that was kind of the biggie that I'll end up hitting. Every week we get the MBA mortgage applications index. It was actually up. We've been seeing a general decline, and it ended up being up 2.7%, where last week it was down 0.1%. Retail sales, this was the biggie. They were up more than expected. The market could have freaked out on that, but didn't. They like the fact, when I mean they, I'm talking about the stock market, that consumers are hanging in there. They're going out and buying stuff. Now, that can be inflationary, but that can also suggest a stronger economy without it getting too strong, because we are seeing a lot of inflation right now. And so at least in Wednesday's session, it didn't bother the markets all that much, even though we were negative. They expected it to be up 0.9%. It was up 1.3%. So that was quite a bit different. If you take out automobiles, we were up 1.3%. It's almost a little more than double what they expected at 0.6%, where last time it was up 0.1%. Export prices declined 0.3%. Last time we got this, they were down 1.5%. And yes, okay, I'm not understanding what that from is for. And export prices, if you take out agriculture, they were down 0.3%. The last time we got this, they were down 1.6%. Import prices also declined, down 0.2%, where last time they were down 1.1%. I'm still dealing with this inner ear thing, and it's making me quite dizzy and incapable of speaking sometimes. And import prices, if you take out oil, they were down 0.1%. Last time they were down 0.3%. Industrial production declined, down 0.1%. They expected it to be unchanged. Last time it was up 0.1%. Capacity utilization, and 80 is my understanding kind of the line in the sand, where when we're above 80, we're growing with our capacity utilization. When we drop below 80, we're contracting a bit with that. They expected it to be at 80.3. It came in at 79.9. The last time we got this was at 80.1. Our trend is still neutral, but it's getting stronger. It's hanging in there. It's turning up above the moving average. I have a chart to show you. And the green line, even though it's declining somewhat, is still positive. I've kept our bias more at positive, even though we had a down day. It's still, I like at least from my perspective, it was a healthy down day, because it's just showing some exhaustion after really going up, and we haven't really changed the climate all that much, and our momentum I'm still keeping as positive. I just want to keep showing this chart just because we have tracked it pretty closely, where the green line is 2006 through 2008. The white line here is all the way up to the current time. But again, this is getting older. This goes back to November 11th, and how, at least if we track it to what it did in the past, this really declined going forward from here. We'll have to see how that plays out, but just something to be aware of. Here's our trend showing how the line is starting to come back up. We're still under 20, but we're crossing above the moving average, and the green line is still on top, even though it is declining. Here's the daily chart, just showing the small range that we had for the daily session after coming up to R1 in yesterday's session and then coming back down. We're still above the 50 overall, and you can see at the bottom where volume dropped below average. Here's our daily charts. We came up to the 200-day moving average, which is always interesting to me. We hit a pivot point, which is just about at the 200-day exponential moving average before coming down. We'll have to see. Can we get some more strength to go above that, or is this exponential moving average going to be a more significant resistance level? The fib levels also, it's kind of interesting how these are lining up with each other, where we came up to this 61.8% retracement level and have been backing down since, but we're still above this other level at 50%, which is at about 3809. Excuse me, 3909. Those numbers are pretty difficult to read. 3909 to 3910. I wanted to show this again because this sometimes gives us a little heads up as to what's happening. Even with the down day, the Swinland trading oscillator turned up based on price and was slightly higher to flat to higher based on volume. So that can be somewhat encouraging. And here's the equity put call ratio, how it really, really spiked up. Folks were just loading up on puts in Wednesday's session, big time. And so that'll probably take out the spike from not so long ago and eventually work its way into our 5-period simple moving average of this chart to see if that generates a new spike. Our new highs, new lows, not really a lot changing. I just wanted to show this to suggest that the 5-period is still above the moving average, even though we're declining overall with the 10-period moving average. We saw no breakout at all, a few little new highs, but that was it. And one warning sign is the summation index based on price that continues to advance. That's calculated one way, where the summation index based on volume has started to turn down, and that's calculated differently. So what's our outlook then for Thursday? The technicals still remain positive, but we're still showing a lot of short-term overbought indications and a few in the intermediate term. We have housing starts, building permits, jobless claims coming out in Thursday's session. This will give us some housing data. And then all the geopolitical events, I've taken Poland and turned it back to white just because it looks like that might not be as big as initially thought. Interest rates and inflation, that'll still be the concern. Any Fed speak that we get, and then all these other things that, as I always say, could come to the forefront and have an influence on the market. So our scenario is not going with the down one, even though we still remain short-term overbought and a little bit intermediate-term overbought. That could produce a bit more weakness. But as far as our trend and our indicators, like all of our oscillators are still going up and other indicators that we use are still positive. I have the up scenario in blue, kind of a baby light bluish green, because we are looking more positive technically, but we're short-term overbought, with some of the intermediate term also being overbought. Our scenarios, yeah, they showed a little bit of weakness in Wednesday's session with the down day, but they're still holding up for the most part, and our positive setups are as well. Technicals still look positive overall. We're kind of dealing with the 200-day exponential moving average currently, as well as some of these pivot points and fib retracements, as well as overhead resistance. So we're going with the sideways because the ADX, although it's getting stronger, is still below 20 and it is positive. So our conclusion, the S&P is positive, but it's still overbought. Short term, it's mostly overbought. There's a few of our short-term indicators that are coming back down, like the force index, and I think some of the shorter-term stochastics are looking a little bit better. Intermediate term, we're still positive there, but slightly overbought. Where long-term, we continue to be negative. So thank you. Have a really good Thursday. I had thought about doing a full-length video, but I'm just not up to it yet, health-wise. We'll see how things go in Thursday's session. I doubt I'll be putting one out for Friday. And so the next time I do a full-length video may be over the weekend if I'm capable of doing that. So have a great day, and I'll talk to you in the next video.